What? Good morning. How's it looking? We can talk about the month of June in isolation and talk about the painful underperformance in India, but the minute I connect May and June together, Indian markets are simply mapping global markets.
Yeah, so the key issue for the G20 meeting is whether China and the US can reduce trade tensions. So we had a big escalation in trade tensions in early May as the US accused China of reneging on what they had already agreed. And we saw markets selling off pretty sharply on the back of that, particularly Asian markets such as China, Korea, Taiwan, where they really are impacted by these trade disputes. So the question is, what are Xi and Trump going to say after they meet? Are we going to get a broad statement from the G20 about an improvement in trade? I suspect probably not. The other G20 leaders obviously are against this trade dispute that Trump has instigated. But I do think there is a modest chance that both the Chinese and the American delegation come out with some few words that effectively reduce trade tension for now. But I think it's incredibly unlikely that we actually get a deal discussed and signed at this event. So I think it's really part of the journey in the trade dispute rather than being a watershed event.
Now, in India, there is a key event of budget. What do you think FIIs and global investors should expect from the budget?
Well, actually, I think very little out of this budget. People have been asking me about, are we going to see a stimulus? Is this budget going to be good for growth? I would be very surprised if that was the case. You know, the way that budgets work in an election cycle is after a strong victory, you tend to get a degree of fiscal prudence, a bit of fiscal tightening. And so the impact of the budget on growth is usually slightly negative. You do, though, get an offset in that there is a degree of political stability and business investment has a bit more clarity. Business confidence tends to pick up after you have a strong election result. So I think the budget is negative for growth, but the election result turns out to be positive for growth because it provides a greater number of years of clarity in terms of political policy.
Adrian, hi there. Good morning. Now, in terms of fiscal deficit, if the slippage is about 10 to 15 basis points pushing growth, do you think that investors will take this positively?
This is the time for the government to be a bit more fiscally prudent. They don't need to be out there stimulating the economy in order to encourage more people to vote for them. So my expectation would be a prudent budget, one in which they target a reduction in the fiscal deficit. I think if we don't see that, if we see a budget that is pro-growth with a rising fiscal deficit, then the market should probably treat that negatively as it would indicate a less prudent economic stance from this government.
And in terms of sectors, you know, the expectation seems to be really a focus on infrastructure spend and what has been done with the NBFC issues. What do you make of it with perspective to the fact that the budget, is likely to focus on these two factors?
Yes, so I would imagine the finance minister will discuss both of those. But remember that this is the same administration that's been in government for a period of time. It's a government that in its previous term was focused on infrastructure, and infrastructure spending did pick up. I don't see any reason why there's a change of direction, why there's a major delta just because they've won a general election when it comes to infrastructure spending. The issues around NBFCs and underfunded PSU banks have been troubling the Indian financial system for many years. These are difficult issues to address, particularly the use of public funds when you're trying to deal with private or quasi-private non-bank financial companies. So I think this story will be with us for many years to come, rather than resolved in the budget post the general election.
Right. Adrian, one of the reasons for the growth being slow has been the NBFC issue that we've been, scarred with of late. Do you really think one needs to solve that to see a pickup in growth coming in?
Yes, so I think it's rational to give an impact on the NBFC issue onto the economy. When one thinks about monetary policy, you tend to be very preoccupied talking about what the Reserve Bank is doing, where interest rates are. But remember that there's two parts of providing money to the economy. There's one is what the central bank does, and then there's the state of the plumbing, there's the state of the financial system. So the financial system in India got a pretty severe hit with the trouble that we've seen with non-bank finance companies, particularly in the infrastructure sector. And so that will have had an impact on the economy through the distribution of credit. So addressing that is important, but I don't think there is an easy fix for this. It's going to take time to recapitalize, and then people's confidence in these different institutions will not recover overnight. So maybe you can find another way of channeling capital to these projects. But even that, I would be somewhat wary about being overly optimistic about, because you tend to find the PSU banks are very risk averse at this point. The management structure of the banks are being criticized for bad loans rather than being criticized for not making sufficient loans at this point in time. The private sector banks in India have enough profitable opportunities without really needing to fill the gap that the NBFCs have opened up.
Right. So, Adrian, if fiscal prudence is maintained, do you think rates in India will go down further in the next RBI meet?
See, I think there's a chance of further rate cuts in India, as we didn't see follow through in higher inflation that was feared when the currency had been weak and when the oil price had been rising. And so I think that there is a good chance that the Reserve Bank has the flexibility to reduce interest rates if that is felt to be appropriate in order to stimulate the economy. What we already discussed with the NBFCs is another argument in the central bank having an easier stance than it would normally do if you didn't have problems within the financial system. And this is probably a lesson that we need to take from the developed economies where we've seen the Federal Reserve, the European Central Bank, the Bank of Japan, the Bank of England, all running a very, very accommodative monetary policy, partly to offset problems within their financial systems.
Okay, now in H1, India has underperformed the rest of the world. Why do you think this underperformance has happened, and what do you think one should expect tactically in H2?
Well, I think there's a danger in these point-to-point analysis. India was a significant outperformer in the final quarter of 2018. It did not have the recovery trade that you saw in many markets in the first quarter of this year because it hadn't fallen to the same extent. It's then performed significantly better than most markets in the second quarter as the election result came through as a positive surprise. It was less impacted by the trade disputes and also was deemed to be the major beneficiary of the surprise decline in the oil price. So I wouldn't take too much out of reading the first half underperformance. I think that really tells you more about the recovery trade not being something that India needed to be part of. Now, the question, I suppose, is what happens for India and the rest of EM in the second half of this year. I'm relatively positive on equity markets. I think the pessimism around economies is slightly overdone. we have an environment where discount rates are very low. We've had a modest slowdown with a particular hit to business sentiment around the trade dispute. If you get an easing in trade tensions, then I think that equities will do well. And I suspect within emerging markets, if you do get an easing in trade tensions, then the equity markets that do the best on that will be North Asia, so China, Korea, and Taiwan. And so I think India goes up, but it could lag those markets if it's a rally that's driven by a reduction in trade tensions.
Now, Adrian, US rates are low and India MSCI premium to other emerging markets is lower than that. Does that make India attractive versus the rest of the world right now?
Well, it certainly helps, but I would also note how much US 10-year yields have come down. So the most important discount rate has come down. It's come down at a time where there has been earnings growth in the last 18 months, particularly in markets like the US. So there has been a significant P multiple derating in US equities since the first quarter of 2018. And there's also been a decline in US bond yields. So I don't think India is unique in having a P multiple decline and a decline in discount rates. It seems to be a global phenomenon. The reason that it's occurring is that confidence in economic growth has deteriorated. That's partly a function of people's views on being very late in a protracted economic expansion. It's also concerns around US policy, particularly trade policy, and how that can be damaging for business confidence and business investment.
Right. Adrian, small caps in India are down a good 4% in the first half. And at the same time, you've got the Russell 3000, which is up more than 15%. What does that mean for flows ahead in the mid and small cap space in India?
Yes, so I would think that there are some specific factors there. We were discussing the non-bank financials earlier. They are an important source of capital for small to mid-cap businesses. If you have disruption in a financial system, the larger companies tend to have more options. The smaller ones tend to be impacted by this. So I think that is probably why you're seeing India's small caps underperform. Now, the performance that we're seeing in the US, I think is partly that with the Russell 2000, the smaller companies, you've got some domestic industrials. Some of them may be deemed to be beneficiaries of tariffs and tariff protection. So they're probably being helped by that. You're probably also being helped by the composition of the index as well. So I think I would look at very specific local factors to explain the performance of small to medium-sized companies, whereas with very large index constituents in both markets, which tend to be a little bit more global in nature, then we'll have factors that will have a chance of being more common across the Indian and the US market.
Adrian, great to have you on the show. Thank you so much for taking the time out and speaking with us today.